even more expertise for you. Michelle Schneider is with us, Managing Director of the Market Gauge Group. It is great to have you, Michelle. When we think about the sudden risk aversion, what sparked it? Was it CPI print on Friday? Was it crypto over the weekend? What?
Well, to some of us, it wasn't really a great surprise. The velocity of it happening really has come from the fact that people have been in denial that this was going to happen, that inflation hasn't peaked as many thought it might, that the fact that the Fed is going to remain hawkish and they might actually pivot that if they start to see things going down, PE ratios, et cetera, hasn't happened. But the thing that's really interesting to me right now is even though there is some sense of reality, clearly the liquidation we're seeing not just in cryptocurrencies, which of course turns out to be much more of a risk-adverse asset than people originally thought, is the idea that the Fed can somehow, by raising rates, whether it's 50 basis points or 75 basis points, control this type of inflation. We have a unique type of inflation. We have a supply side, not supply chain. That's different. People get that confused. Supply side inflation, which means that food is not being produced fast enough and probably won't be produced fast enough. That oil, even though there's a trip pending to go to Saudi Arabia by the Biden administration, they're down in their reserves too. So even if they release more, it may not be enough. And this cannot be controlled by higher interest rates, unfortunately.
I want to talk about those higher interest rates, a 3-year yield that's now up 20 basis points on the day, a 2-year that's up 19, everything across the curve is up about 19 to 20 basis points. What cues or signals is that telling the Federal Reserve?
Well, in some ways, I think the Federal Reserve might be hoping that the market does their job for them. But certainly the signal that they have to be getting right now as they're watching the market melt down is that most of these companies, particularly companies that have not done well, other than the fact that they had zero interest rates and free money, are going to probably suffer more, that labor is going to suffer more, that wages can't keep up. So they're going to be in a real pickle here because they're going to have to make a decision. It'll be interesting to see what they do on Wednesday. But like I said, regardless of even if they say, okay, we're going to join the market, we're going to jack up these rates, we're going to get these Fed funds eventually up to 6%. Can that really control what's happening with the supply side and war inflation, which is something also people seem to forget about, is that the Ukraine produces a lot of food and Russia exports a lot of oil.
So, Michelle, you're painting a pretty bearish scenario where demand presumably decelerates as a result of Fed tightening, but supply remains somewhat constrained. How are you positioning within this market, via cross assets or even within the equity market right now?
Well, Gina, happily, I heard you say in the very beginning that this is a commodities type of market, and that's very much the case. We really believe at Market Gauge that we have just really started a commodity super cycle. As everything is cyclical, obviously we've gone through a very long period of an equity bull cycle. That is over. Now, does that mean we'll crash? Not necessarily. It could mean we find a trading range like a stagflation environment would do and had done in the 70s. But commodities, I really believe, especially precious metals, haven't really started getting going yet. I think food has more upside. I think some of the softs have more upside. Even the energy and oil market probably has more upside. And so we're really looking now at positioning more into gold miners, silver. We're already in some of the softs and some of the grains, particularly wheat. We may want to add to that. That's really, I think stocks right now would be more of a distraction. And commodities would be a better place to put some money.
And Michelle, of course, we discussed, the recession risks that are brewing everywhere, really. How much are you looking inside the U.S. or externally?
Well, what's interesting right now is, there's the textbook definition of recession, and yet we're not actually in a recession yet. Obviously, declining GDP over 2 quarters is the textbook definition, and we may see that. But I really believe that because we have a unique situation here coming out of COVID, China still has to emerge out of COVID, that the recession may not be really the defining thing. It's really going to be more that we haven't seen any real economic expansion for years, and we'll just stagnate as opposed to turning down. And I think it's because of COVID, basically. We were already really in the dreads, and now we're just sort of more above that, but stable. Could we go into recession? Absolutely. But right now, that's not my biggest concern.
Michelle Schneider, great to catch up with you. Market Gauge Group, stay well. See you soon. Meanwhile,